slides are coming up. Good afternoon, everyone. Thank you for taking out your valuable time and joining us for this webinar on global macro outlook and business risk management. Now, we all know that 2020 has been a challenging year as normal life has been disrupted because of coronavirus. So as business owners, you are well aware of the impact of coronavirus on the various sectors of economy. Now, the big question in front of us is how soon can we expect the things to normalize and how to navigate the journey there. With this in mind, over the course of next 25 minutes, we will take you through the view that we have on global economy as well as key asset classes. That the last time the world faced a pandemic of similar magnitude was Spanish flu of 1918. There aren't that many lessons that we can draw from history regarding how the global growth recovery will take place. Hence, with this in mind, at Standard Chartered's Global Investment Committee, we have identified these 6 factors that we are monitoring as we track the recovery of global growth. Now, first and foremost, obviously the evolution of coronavirus or COVID-19 is something to watch out for. And although the total number of daily cases are around 100,000 per day, it is encouraging to see that cases in previous epicenters such as Spain and Italy. DJ, I think you can just remove that. In epicenters such as Spain and Italy have been declining, and the same has been happening in Singapore. So that's an encouraging sign. Now, secondly, if you talk about the state of lockdowns, most economies have been gradually easing lockdowns and restarting the economic engine, Singapore included. But as far as this aspect is concerned, there are 2 things that we are watching out for. First is obviously what is the pace of easing of lockdowns? Because right now, everyone seems to be quite optimistic that lockdowns are opening at a good pace. But the risk obviously here is that the easing of lockdowns is slower than expected. And secondly, the big question in front of all of us is how will the governments react if there's a second or third wave of infections? So while things are going in the right direction, we think these are 2 risks to monitor. If we talk about monetary and fiscal policies, this has been one area where we've really been surprised in a positive sense. So if we talk about monetary policy or the support from central banks, it's been unprecedented. The Fed has cut interest rates to 0. And if you talk about major central banks across the world, be it Europe, US, Japan, and even a lot of emerging market countries, they have embarked on quantitative easing in order to support the financial markets and the economy. If we talk about government spending or fiscal policies, again, we have seen never seen before measures being announced. And the size of those measures has been large as well. So if we talk about the total amount of stimulus measures that have been announced in places like Germany and Italy, they amount to about 35% of the GDP. And if we talk about Singapore itself, the total measures that have been announced till now amount to about 20% of GDP. Now, these measures are far, far larger than what we saw during great financial crisis. Now, the question is, why is this important? And that's down to 2 reasons. Firstly, such large measures mean that the risk of downside to the economy, to the businesses has reduced. But at the same time, it also means that the chances of recovery are quicker as the chances of permanent and lasting damages are lower. Now, as business owners, you're probably well aware of the challenges the current environment is causing towards corporate earnings. And we admit that in 2020, on an average, the corporate earnings will decline. However, on the bright side, we think that in 2021, we should see double-digit earnings growth from corporate earnings, at a global level. And last but not the least, if we talk about other risks, we were thinking about geopolitical risks, and we've really seen the US and China tensions flare up, especially around Hong Kong in the past couple of weeks. So US-China tensions, as well as the risks around Middle East, are something that we are conscious of in terms of downside risk. If we move on to the next slide, it shows how do we view the evolution of global growth. So at a headline level, we are more sanguine about global growth than what market consensus expects. So if you look at the chart on the left, what it shows you is that at Standard Chartered's Global Investment Committee, we believe that yes, global GDP will contract in this quarter, but the contraction will be much less than what markets are expecting or what markets are fearing. And the reason for that is we think that some of the economic data that has been coming out, some of the indicators as far as economies are concerned, they seem to be better than what most people feared. That being said, it's still important to note that in quarter two, especially for US and Europe, we are expecting economy to contract anywhere between 40 to 45% on a quarter-on-quarter basis. So that's a big decline. But if you look at the positive side or the light at the end of the tunnel, we think that in quarter three, we should start seeing global economy starting to recover. If we talk about China, we think China is in a much better place. We think the overall GDP growth for 2020 should be somewhere between 5.5 to 6%. So China is less impacted than US and Europe. And the key reason for that, obviously, is that China was a lot more successful in containment of coronavirus. If we move to the next slide and start talking about emerging markets, we think that the recent recovery in oil prices is a big positive for emerging markets. And that's down to two key reasons. First and foremost, emerging markets are net exporters of oil. So the increase in oil prices helps emerging markets not only in their export revenues, but also contributes to the government tax revenues or government income through royalties, which is important at this time, given that most emerging markets are stretched at the moment. Secondly, while to a certain degree, the increase in oil prices has been led by supply cuts, a big contributor to the increase in oil prices over the past month has also been the uptick in demand. And that bodes well for emerging markets, because if the demand for oil increases, that's an indicator that the global GDP growth is also on track of recovery. And emerging markets as a whole are likely to benefit more from developed market countries when the global growth recovery starts to take place. As far as oil prices are concerned, we think that the sharp rally in oil prices that we have seen over the past couple of months means that oil prices could remain range-bound in the next 3 months or so. But on a 12-month horizon, we are bullish on oil prices, and we think that oil prices will rise higher from where they are today. So what does this all mean for our view on the global markets? So if we move on to the next slide, at a headline level, we are bullish on global equities, as we think that global growth will start recovering in quarter three onwards, and growth-linked assets such as equities should outperform. Within equities, we are obviously bullish on Asia ex-Japan equities, as well as US equities. If we talk about bonds, at a headline level, we are neutral on bonds, but within the bond markets themselves, we think there is an attractive value out there in the corporate bond market space. And we are bullish on Asian dollar as well as US dollar government bonds. If we move on to currencies, over the next 12 months, we are bearish on the US dollar, and we are bullish on the euro, the pound, as well as Australian dollar. Last but not the least, we are overweight on gold because we like gold for two reasons. One is obviously the function it serves as a hedge, especially in times of market stress or economic stress. And also because we think, gold prices have the potential to rise substantially from here and maybe touch 1850 in the next 12 months. And my colleague DJ will be touching more upon that later on in the presentation. But let's spend 2 or 3 minutes talking about our view on equity markets. So, like I mentioned earlier, we are bullish on equities because we think global growth will recover. And like I mentioned earlier, corporate earnings are likely to decline this year in 2020. But in 2021, we expect double-digit corporate earnings growth, both in US and Europe, which are the largest equity markets globally. And if the thing about equity markets is that, they are usually forward-looking. So if the markets are convinced that, we are on path of global recovery, then they will, sort of ignore the decline in earnings in 2020 and start looking forward to 2021. Now, obviously, you could ask me, why should we be bullish on equities, given that they've rallied nearly 35% since the lows we have seen in March? And that's a very, very valid point. However, if you look at the year-to-date performance of global equity markets, and this chart is a few days old, it shows that year-to-date global equity markets are still lower than where they started. If you move on to the next slide, if some of you have been following the news headlines recently, you may have also come across articles which highlight that equity valuations may be starting to look expensive, especially on the PE ratio basis. And that's something you can see on the light blue line on the chart here. Now we think that that's not a complete picture. PE ratios for equities have increased because although equity prices have fallen from start of the year, earning expectations for 2020 have fallen by a greater amount. So the denominator has come down, and that's led to an optically higher PE ratio. However, if we look at equity market valuations through other lenses, then it can be argued that equity markets are cheap or maybe even fairly valued. So what we did, and we don't have a chart for this, but what we did was we looked at equity market valuations after adjusting them for the business cycle. That's something called CAPE ratio. And what that shows us is that once you adjust equity markets for business cycle, valuations are close to fair. Another way of looking at equity markets is obviously comparing it with safe bonds, safe government bonds. And what the black line on the chart shows you is that the dividend yield offered by equity markets is now much higher than the yield you get on safe government bonds, given that government bond yields have declined so much. So even if equity prices were to stay flat to where they are right now, we think that they have a very good chance of outperforming global bonds. With that, maybe let's move on to bonds. So like I mentioned earlier, we are neutral on bonds because we see a few opposing factors in play. On one hand, you have the fact that government bond yields are very low. In US, obviously, the Fed has cut rates to zero, bringing treasury yields quite low. And if we talk about Europe and Japan, government bond yields are negative there. At the same time, the risk of corporate defaults has increased. But on the positive aspect, you have valuations which are quite attractive. Now, within bonds, we especially like corporate bonds. And I believe that is something that could be of interest to some of you in the audience, given that I know some companies use corporate bonds as short-term investment vehicles to park the money. Now, why do we like corporate bonds? Now, I mentioned that valuations in equities are not cheap. They may be fair, but overall, it's difficult to argue that valuations are cheap. But in corporate bond space, valuations are cheap. And if you look at the chart on the right, credit spreads, which are a measure of valuation, have increased since start of the year. So higher credit spreads means cheaper valuations for bonds. And if you look at the chart on the left, it shows that the current valuations, which are denoted by the dark blue line, are higher than the 5-year averages. So valuations are cheap. And what current valuations mean is that over the next 2 or 3 years, as valuations normalize, investors can not only benefit from the high yields on offer right now, but they can also expect some capital appreciation over the 2-3 year horizon. If we move on to the next slide, we also think corporate bonds are likely to benefit from increased demand from income generating assets. With safe haven assets like government bonds offering you next to nothing or even negative yield, we think the 4 to 6% offered by Asian dollar or EM US dollar government bonds stands out as quite attractive. So valuations are attractive, and we think that demand supply perspective also favors outperformance of corporate bonds over the next 12 to 18 months. Now, I know I have not covered why we specifically like US or Asia Japan equities, or even Asian or US dollar, Asian or EM US dollar government bonds. But I'm very happy to take those questions in the Q&A session. So if you have questions about anything, please feel free to type those out in the Q&A box, which you'll see at the bottom of the window. With that, I'll hand it over to DJ, who will take you through our views on key currencies. Thank you.
Thanks, Abhilash. Sorry about the technical difficulties earlier. Hi, everyone. First and foremost, I would like to thank each and every one of you for taking the time to join the webinar today. As Abhilash pointed out earlier, we are living in a world with elevated uncertainty, given ongoing COVID-19 pandemic and also rising geopolitical tensions. As business owners, I understand that FX is probably a crucial component to your business, and I will spend the next 10 to 15 minutes covering our FX views, focusing on a few currencies. Now, if we move on to the next slide, our key theme here is broad dollar weakness over the next 6 to 12 months. In fact, safe haven demand has been an important driver of the dollar since the COVID-19 pandemic began. And in the near term, we think the dollar will continue to trade sideways and could be potentially volatile if geopolitical tensions continue to rise. Now, with DMFX, i.e. your euro, pound, and Japanese yen, recently registering some gains against the dollar, the other signpost we are keeping an eye out for is whether EMFX, i.e. your LATAM currencies, Asian currencies, whether these make a sustained recovery against the dollar in the near term. Now, as the global economy continues to reopen, like what we're seeing in various countries, and financial conditions remain fairly easy, we believe the reduction in emergency dollar demand should gradually push the dollar lower. As the last point I'd like to make is that US exceptionalism is also unlikely to last as other countries restart their economies and global growth gets back to its trend line before the pandemic happened. So with that in mind, let's touch on the euro. We are bullish on euro dollar, and we believe the pair can hit around 113, 115 over the next 6 to 12 months. Here are some of the reasons why we like the euro. Number one, now the recent development around, or the recent announcement by the European Commission to boost its budget with around euro 750 billion of borrowing is potentially a game changer. And what this means is that the euro area will be using debt that will be repaid by EU-wide taxes, grants, and loans, which will be given to countries that have been worst hit by the COVID-19 pandemic. And these countries will likely be Italy and Spain. These will be one of the biggest beneficiaries of this announcement. Secondly, euro area breakup risk. Now, these have significantly been reduced. While we expect some resistance from the frugal four, i.e. Austria, Denmark, Netherlands, and Sweden, we know that these countries are still open to negotiation. And lastly, our expectation of a pickup in global growth, like what I alluded to earlier, should also benefit the euro, given its reliance on trade, while the dollar is a counter-cyclical currency. Now, moving on to the pound, I'll just touch quickly on the pound. We are also bullish on pound dollar. We do expect the pair to trade around 127 over the next 6 to 12 months. Now, while the UK and EU have made little progress on agreeing on a future trade partnership, we see near-term risks for the pound. Namely, given the current transition agreement states both parties have until end December to ratify a trade deal, and that any extension to this deadline has to be agreed by 1st of July. Now, we are approaching that deadline soon, and we believe that there is a possibility that investors may not be adequately pricing in the risk of a no extension request. But if you take a step back and look down the line, we ultimately believe that the deal will be agreed, and the removal of the Brexit overhang should bode well for the pound going forward. Additionally, cheap valuations underpin our positive view for the pound. Now, on dollar CNH or the renminbi, US-China relations, developments in Hong Kong, they have dominated headlines of late, and I'm also sure some of your lunch conversations as well. While the CNH is vulnerable vis-a-vis the dollar if tensions rise, we do note that policymakers, they remain focused on maintaining financial stability and averting big capital outflows. If you take what the central bank has been doing of late, we believe they have the intention as well as the capability to prevent a sizable currency depreciation. In addition to that, now the government's economic projections announced at the MPC meeting over the past few weeks, they have been pragmatic and they will be supported by proactive fiscal and monetary policies. So looking ahead, we think the pair can trade around 710 over the coming months. And while I don't have the chart here, I would like to talk about the Aussie dollar, given the recent strength we've seen, at least against the dollar and against the Sing dollar. And while we have a bullish view on the currency, we did not expect the extent of the rally nor the ease of the move in recent days. We think the pair should enter a period of consolidation over the coming days. But if you take a step back, we do note that Australia has been very successful in containing the COVID-19 pandemic. It's also one of the earlier countries to start reopening its borders, allowing businesses to get back on track. However, in the near term, rising US-China trade tensions lurk in the background and will be a headwind for the pair over the coming weeks. With that in mind, let's move on to dollar Sing. Now, as business owners and as locals here, everyone must be wondering, so you've mentioned about all these currencies earlier, what does this mean for the Sing dollar? Let's take a step back and approach this view, at least with regard to our dollar view, and like what I mentioned earlier. Singapore, being an open and export-oriented economy, will remain under pressure as global growth and trade gradually recover. After taking into account recent forecasts by the MTI, which showed 2020 GDP forecast, we are expected to register a negative 7% growth this year compared to negative 4% growth in the previous forecast. If you look at what the Ashley-Near basket has done, it is still trading slightly around the midpoint of its policy band. And if you look at what the MAS has been saying in recent commentaries, they have pushed back against an off-cycle meeting, and they have continued to stress that FX policy is a complement to fiscal and liquidity policy. Taking all these factors into account, we believe this indicates a range-bound dollar Sing over the next 6 to 12 months. Moving on to gold, I'll just touch quickly on gold, given that we have time constraints over on our end. We are bullish on gold prices, and we continue to see several tailwinds for the precious metal. We expect the precious metal to trade above 1900 over the coming months. In short, as gold is a non-yielding asset, real yields, net of inflation, are key to the outlook. If you look at the monetary expansion we've seen so far, this should keep real yields lower for longer and benefit gold prices. In addition, geopolitical risks also argue for higher gold prices going forward. I think I've covered a fair bit of currencies in the past few minutes, so I'll just skip through some of the disclaimers that we are regulated to show. And just moving on to this slide here, which is the QR code, please contact us if you have any inquiries or you'd like to give feedback on the webinar. What I'll do is I'll leave this slide here up for around 5 to 10 seconds, and then I'll hand it over to my colleague Zach, who will take you through next presentation. Okay, thank you everyone.
Thank you, DJ. Thank you. Let me share my screen first. Hi everyone. My name is Zach. I am the GM of Business Banking. Hope everybody is well. Thanks DJ Abhilash, my two learned colleagues, for taking us through what we as a bank feel would be the next few months. I mean, the future is clearly uncertain, but with some educated guess, I guess we can prepare for the future. I am aware that there has been a few webinars from other banks as well, taking you through what are the working capital solutions available. So I will not touch on that today. I am going to talk about something closer to home, which is about cash flow. It's just 4 slides that I have, so bear with me for a while if I sound like I'm preaching to a pastor or teaching a fisherman how to fish. I mean, a lot of you would have a lot more experience in business than me. Okay, let's go. Cash flow is king. I'm sure you will agree with me. Cash flow is like blood to a business, right? It's important to ongoing survival. Poor cash flow management will lead to business failure. And one of the things that I hear from my SME friends is always that, hey, my business is profitable. I don't know why I'm in this situation where I have to talk to a bank about my problems. So really, a profitable company does not equate to a no cash flow situation. We just have to keep that at the back of our mind. Yep. Some common problems that SME face. Let's talk through. Late payments. I guess a lot of us are very optimistic. I mean, most SME owners tend to be very optimistic about their business and whether they can collect payments or not. And these late payments sometimes are unexpected, but it caused a bump in the road, right? This is coming from a banker's perspective. I've been speaking to SME owners for about 15 years, so I'm just going to bring up some examples to share to make it more relevant. There's some businesses have a lack of focus and understanding of key financial ratios. Yeah, I understand key financial ratios. They are very banking terms, but I think the core and important thing is understanding and have a clear view on what is your receivables and what is your payables. There are so many times when I speak to SMEs and to understand their AP and AR, and they will tell me, wait, I talk to my finance. So talking to a finance doesn't mean that you have visibility, and this is lifeline cash flow, right? So you have to have a clear line of sight every day. Of course, SMEs tend to take advantage of times of low pricing to stock up, right? But there are times, I mean, depending on the kind of goods that you are stocking up, over hoarding is a bad thing. To buy too much of a fat item is definitely a bad thing, because then you will have problem disposing. Mismatch on financial facilities. Again, this is from a banker's perspective. Sometimes customer will tell me, hey, sorry, I'm Teochew, so I'll say Teochew sometimes. What ului jib like ului chuk right? But then I have money coming in and I have money going out. I think there's flow. But then sometimes we need buffer, right? You need buffer to take care of the unexpected bumps in the road, like late payments. So don't plan it too tightly. One point to note is a small point. Bankers always tell SMEs, say, think about forking out some money from protection. Yeah, but of course, SMEs, being SMEs, is to maximize profit, minimize cost. So that one I can perfectly understand, but this is some consideration, right? Failing to pay stuff on time is a lot of times is the last straw lah. Okay, let's talk about what I feel are the key areas that we SMEs can look into to revamp cash flow. 3 points that I think have to be spoken together. First is easing the account receivables. Second, optimizing account payables. And at the end of the day, the objective is really to shorten the overall working capital cycle. How much you need to pay your suppliers versus how much you have to come in. And in the middle is probably how much you will have to borrow either from the banks or from investors, right? So how to ease account receivables? I think this is clearly bread and butter of every business. But there are some businesses that I talk to. They don't have clear terms, credit terms on their invoices. They go by way of 信用. You have somebody who is buying for you for a very long time and tell you, okay, I'll pay you back 30 days. But then many times it goes to 45 days, 60 days, right? That will cause strain on your cash flow very clearly. Of course, now the government has made collection very much easier via Pay Now collection, right? In the last 2 months, I think because of the job support scheme and customers having to get the money faster via Pay Now, we see so many of the customers suddenly jumping on the Pay Now bandwagon. And this is good because then you don't have to wait for checks to be cleared. You don't have to wait for the money to be transferred. Pay Now is a very good option that you should be considering at this point. Of course, you like I said earlier, you need to have visibility on your account receivables and your AP together. Then you know your cash flow situation. What a lot of SMEs have is an Excel, and that Excel may not cut it. So at least in StanChart, our online banking system for corporates, we have a cash flow view, but I know it can be a little bit sophisticated for some of our customers. So we have actually partnered with an accounting software firm to come up with this thing called Cash View. I mean, I can share a little bit more in private about this. But this cash view will give our customers or the user a very good view on the cash flow projection based on your ERP data. They will tell you whether you are going to be positive cash flow, negative cash flow, whether you need to seek financing or not. Perfect solution, right? Of course, it is always an opportunity cost. You can give discount to get money back earlier. Yeah, this is something that some SMEs refuse to consider because it eats into their profit. But in the long run, actually, is a good thing. Earlier I said don't overhot stocks. All this will help you look into your AR, AP, and overall working capital cycle. Good to know, is a good reminder, but I believe everyone online is already aware of all this. Okay, last, not last, the other thing that I want to tell you, of course, is as a banker, I say don't secure a credit line only when you need it. I know it is cost, but I'm sure a lot of you are aware that, I mean, there's this saying to say the banks only give out umbrella when it's sunny, but when it is rainy, you take away the umbrella. But I guess the banks are also supported by a credit team that looks at the overall viability of a business. So it is always good when we are not in trouble or not having a cash flow crunch to go to approach a bank to get a buffer line. That's always what I tell customers. It's a small cost, but having a buffer is always good. Don't wait until you have problem, then the banks may have problem helping you. I'm from business, but I always talk to the credit committee about this. So there are challenges, attention there. And when you have money on hand, always try to make your money work harder for you via investment or FX, like what DJ and Abhilash spoke about earlier. But there are many banks that are also giving good interest on current accounts now. For example, like Senchart, I recently rolled out a current account for business banking clients. That give additional interest if you have a loan with us, if you use us for payments or collection, and or you does FX with you do FX with us, right? So all these are will give you additional interest on your balance that is equivalent of a time deposit, while helping you keep your funds liquid, right? And each and every one of these components is actually part and parcel of your work. Is like eating and breathing, but then you are earning interest on it. Yeah. So these are solutions that you can explore, right? Last but not least, secure a protection when it is affordable. When you still can, you are young, go and secure your insurance. And I'm not talking about just insurance, right? Every time I talk to SMEs about insurance, they say, "Wow, life insurance again." I don't talk to you about life insurance, but it is really not. There are so many facets of insurance, and you need to protect your business while you still can, right? Don't be like the latest example would be Stanley Ho. You know, once he dies, some news start coming out about his family. The Teochew idiom will be 求道老高耍, right? We definitely don't want a situation where the main tree falls and then all the monkeys scatter, right? Important is to 留在青山在, 不怕没柴烧, right? We have a green mountain, there's always an abundance of wood for us to burn. Yep. We have come to the end of what I want to tell you. I will hand the mic over to Jimmy, who will take you through, other than life insurance, what SMEs should be considering or can consider about protecting your business, right? Sorry, like I said, I was preaching to a pastor or teaching fishermen how to fish, but thank you for your time with me.
Okay, hi everyone. On my portion here, let me just do a screen sharing. Okay. All right, well, my portion here, right? Thanks, Zach. Yes, on my portion here, I think we'll be sharing, how we can provide cash to business, to tauges and you all, not just rain, but also on shine times, right? Rain or shine, we provide cash liquidity to you guys. My name is Jimmy Teo. I'm taking care of the functions in Stanchart, all right, team head, and together with my guys, we're definitely supporting you in this area. Okay, so first I'll be having an important message. Just want to share, right? So whatever I'm going to share later will not be of any product advice, sharing on any insurance product or any recommendation. I know it's a long stretch of notes, so let me just give you the important pointers. Any example of case studies I'm sharing later are generic, definitely not talking about any customers in particular, right? So don't worry about that. We should seek, if you really should seek any independent legal tax advice, you know, I'm not the best person to assist you on that. Product solution mentions are products underwritten by my respective insurance partner and not from SCB. Lastly, buying insurance is a long-term commitment, and any termination will usually, early termination will usually involve in high costs. Surrender value payable will be less than the total premiums paid. Okay, so I'll be touching on life cycles of the business. What are the, you know, things and areas to look out for each stage? Challenges faced by business owner, not the usual business and operational types, but or rather, you know, different kind of challenges, which I'll share more. Key areas in terms of focus when it comes to how to protect your businesses and properties. And lastly, wrap up with 2 case studies on how to implement some of the solutions. Okay, so first and foremost, life cycle of business. At startup, right, getting business up and running, you know, what are the things that you should be looking out for? I would believe are things like, you know, simple necessity like your workman compensation. How about public liability insurance that you need to get? Depends on the mode of a business and the nature of a business too. How about fire insurance for your warehouse, for your shop? Or if you are doing into, you know, delivery business, maybe you need to have motor insurance for your vehicles, delivery vehicles, okay? We can definitely help you in this area. Stage 2 on the grow, okay? Grow, and in fact, you know, it's a time for expansion, time for building, you know, that's where your business will be busy scaling up. And also for stage 3, expansion and things like that. I will believe at this stage, you'll be taking more of the business loan. So definitely will be, you know, looking at some coverage, insurance coverage should, you know, the business main key person checks out of life. It's extremely important that, example, all loans are being cancelled away, right? So that you ensure that there's liquidity into the business corporate account, your successor, your next generation, if let's say, you know, succeeding the business, they will have time. Basically, you buy them time to make sure that things still move as good as possible, things still business as usual, okay? Lastly, will be things like stage 4, evolve. So I think will be, you know, key thing here will be thinking of like sustainability. How do you ensure that, you know, pass on the business to next generation, for example? Should we have things like shareholder agreement, especially good for partnership, right? And, you know, how about having certain plans that you will want your loyal staff to stay with you for period of time, and then they can get extra certain benefits or perks, or actually some kind of plans involved. Example, endowment plan, income plans, and stuff like that, right? So all these are for a reward should the staff stays a period of time with you, commonly known as golden handcuff. Okay. Okay, so on this, I'll be on the, you know, I mentioned, other than the usual financial operational business challenge, I just want to highlight and share on this interesting article. Up to a certain point of time, the main challenges or a lot of business owners actually, when we engage to and we feedback, right, they often share that, look, this is tough. As the article here says, passing on family business, a top worry among founders. In case you can't read the bottom, the words, let me share with you. Bottom, there are 3 statistics. This is the article taken by Straits Times. First one is on 13% of the people who have participated in the survey says that they will sell the business if the next generation does not wish to join. Okay. Second percentage is 38% says that they will pressure their children to take over the business, family business. Lastly, 50% of the people who participate in the survey says that they are willing to hire from outside, but only until a family members is ready to take over. So you can see the majority of the, you know, business tauke out there, you know, they're thinking that this is my baby. I formed this up. I want to keep this running as long as possible. I would love to pass this to my next generation to run the show. So question would be, you know, you want to pass, but doesn't mean that your loved ones or your next generation may be keen to take over, right? See, even if there was another, in more of a discussion, even when they are keen or they have really successfully took over, I think another headache that they were sharing is, I don't want them to have disputes, you know, fighting, you know, when I check out of life, I'm gone, and then they probably are fighting over it, right? So interestingly, you know, one of the customers shared me, right, in Chinese, right, it says, 我不希望看到我人在天堂，钱在银行，子孙在公堂，right? So he said, he doesn't want that, one day I'm in heaven, my money in the bank, and my loved ones, my children fighting it out in the court case, right? This is, something that I do not want to really envision and want this to happen. So they are asking, so what can I do? What should I do, to solve all this, right? So having said that, I think it's good to important to implement all these key areas and strategies that we need to focus on. Right. First box, if you see on the top left, will be key person protection, right? And of course the bottom, credit protection. I think it goes about ensuring that we do not want to affect business liquidity. We want to stay, ensure business continuity so that when one life checks out, cash walks in. Especially it's the most important person, which is a key person. When he checks out, cash walks in, paid out by insurance policies, so that their business liquidity is not affected. And loan can be redeemed, can be cancelled to reduce liability, to reduce risk, for example, should the next successor wish to do so. Okay, shareholder agreement, I think is good for partnership, like I mentioned, whereby you and I, best of friend, we do business together. But should either party were to be gone, having this document or agreement endorsed by a lawyer, that they say that one family can get the business, ownership of the business, and the other family gets the insurance proceed from the payout, right? Because they mean to say these two partners having done some insurance cover up to the valuation of the business. So and with this document states that one party gone, which family gets the business and which family gets the money. Again, money not from the corporate account, but from the insurance proceed. Again, protecting the liquidity of the business and reduce conflict, reduce fighting among the two families, for example. Okay, last one, employee compensation. The golden handcuff I mentioned about. You want loyalty, you want your staff to stay for a period of time. It could be a good reward, so it can become an endowment plan, for example. Okay, just two quick case studies so that we can wrap up the whole webinar. First one will be, on asset and debt protection. Of the customer, definitely not a real name, Mr. Leong, age 57, staying in Singapore. Semi-retired businessman, two sons, 28, 30, running manufacturing business. He's thinking that I have a 3 million personal loan. I do not want this to fall onto the next generation if I were to be checked out of life prematurely, right? And especially at this crisis, I'm already forced to sell away some of my investment at a loss to generate liquidity. If he feels that this is extremely important, I do not want to pass loan to the next generation. So his portfolio, example, Sing dollar 17 million, whereby majority in business 10 million, property 4 million, having cash and investment 6 million, for example. He thinks that, so what should we do next, right? By taking part of the spare funds from the cash investment, example, a 3 million, we can buy a corporate life plan, right, as a single premium. In case you think that liquidity is still very important, I want to keep, or I want to do partially into my investments. This 3 million can be supported by, in terms of a premium financing. So not the whole lump sum, but you can take a premium financing line with SCB, for example, to facilitate this payment. But having this plan in place, should I check out of life, or should this Mr. Leong check out of life, insurance proceed is actually 8 million, right? 3 become 8, so it's about 2.6, 2.7 times for someone who is age 57. This extra, if you look at the top, total asset 70 million instantaneously become 22 million by just having this plan in place. So the extra 5 million in place, if you want to, or if the successor wants to, they can immediately cancel out the 3 million loan here. Okay. So having this corporate life plan, we create liquidity upon demise of key person, we protect asset liability, and we ensure business continuity. Second and last example, we just want to share that in my team, we don't just plan about customers in terms of their corporate affairs, we also can plan for their personal space. So particularly this customer, Mr. Teo, age 50, staying in Singapore, having this dealer in premium home and commercial appliances. He has an eldest son, 25. He wants to let him take over his business. One beautiful daughter, age 21, not interested in the business. Wife is a homemaker. So his wish is, I want to make sure that everything is divided equally among 3 of them. But it's extremely difficult to ensure that the property and the family business can be quite equally, right? Because these are very illiquid assets and it's hard to divide. So in this area, having in the pie chart like this, example, total assets US 22, just want to highlight that for planning like this, we can use, if it's based on customer preference and based on the fact find done on them, they can use Sing dollar, they can use US dollar, no problem. So for this example, if everything you calculate in US, family property 5 million, family business is in 9 million, cash and investment 8 million, for example. Let's say we take part of the spare fund, having someone who is age 50, the leverage factor or the premium will be definitely in terms of just now the previous example, right? So this is 3.4 times if I put into a legacy plan. I can employ premium financing if I want to, but putting a 3.4 million aside, something would have happened to me. It doesn't pay out 3.4. It pays out 12 million, right? So having this plan involved, I think it involves certain kind of example, doing certain medical tests, like a simple blood test, urine test, resting ECG, or probably even a chest X-ray or a treadmill, okay? Depends on how high is the sum assured and the age that you're entering. So for someone age 50, 3.4 million set aside, something happens to this client, it becomes paid out by 12 million. Instantaneously, from 22 million total asset, it jumps up to 30 million. There's an extra 8 million that is flowed into the portfolio of the family. While keeping the rest intact, the end effect that we want to achieve, like, the customer, Mr. Teo, he wants to achieve is having everyone's equal, right? This will be the end effect. Son, running the business, good at it, you don't want to divide the business. So let him have the business at 9 million, plus let's say 1 million of insurance proceed. Daughter, not interested in the business, it's fine. So you just give part of the asset 3 million and the rest of the insurance proceed of 7 million. Total is also 10. Lastly, spouse, the spouse has worked hard and create this family home with you together over the many, many years. He will want to leave the family home with the spouse. Again, part of the insurance proceed of 4 million and other assets 1 million. Total in terms of value, 10 million. All right. So in net final effect, son, daughter, spouse, everybody is actually having equal value, but just in different assets form, 10 million each. With this, we can actually preserve well. We ensure that things are fair and equitable transfer to the children. From hard to divide becomes, why not don't divide and just make sure that things pass on to the right person and reduce family fighting and conflicts, because it's all equal value of the raw. Okay. Lastly, something to think about. Everyone of us know that it's important to plan ahead to protect business and assets and property, including your own insurance coverage and legacy planning. But question is, have you started planning yours? Thank you. I'll leave this to Tiffany from SCCCI.
Okay, Ken, sure. Thank you, Jimmy. Thanks for the the wonderful presentation, and definitely to Ablash, DJ, and Zach, for presenting. What a wonderful and impactful presentation. I hope all the participants have gained more insights about the upcoming outlook in terms of the economy, and of course how to use insurance to make sure that your assets are well protected. Now we'll be proceeding on to the Q&A session. So for those of you who would like to receive the presentation deck, okay, please take some time to scan on the QR code, which Jimmy, can I have you to share on your last slide itself? Basically, you'll be seeing a QR code, that is stated on your screen right now. Okay, do scan the QR code to fill up your contact details. That you would like to. If you have also any other inquiries, you also can scan the QR code to key in some of the inquiries you have, because currently we are seeing some of the participants is asking for the contact details from Standard Chartered Bank. So for those of you who have any questions that you probably want to ask Standard Chartered Bank directly, also please feel free to fill up to scan the QR code to fill up the necessary information, and Standard Chartered Bank will contact you directly. And after you fill up the contact information from the QR code, do give Standard Chartered Bank a couple of days, okay, and they will also be sending you the presentation deck soon after that. So without further ado, okay, now let us welcome back our 4 speakers for the Q&A sessions. And sorry, one more thing that I've missed out, for those of you who have already scanned the QR code, when you go in to fill up your form, okay, please remember there will be this area where they'll ask you for the nature of the request, okay. Please click click on the enquiries and slash feedback, okay? And when they ask you details of the enquiries slash feedback, please key in SCCCI website so that, you know, Stan Chart Bank from the back end, they'll know that you want to receive the presentation deck. And of course, if you have any other enquiries that you want Stan Chart Bank to contact you directly, please feel free to key in the information too. So now we'd like to proceed on with the Q&A, and as mentioned, we'd like to invite back the 4 speakers, okay? So if you have any questions for our speakers, feel free to submit them, okay, by clicking on the Q&A button at the bottom of the screen and type in your questions. Do note that we do have a limited time for the Q&A session, so we will not be able to answer all questions, and we seek your kind understanding that should your questions not be able to answer during this session, please contact Stan Chart Bank directly with their contact details, you know, featured previously on the screen, or you can email SCCCI and we will also forward your enquiries to them too. Rest assured, for those who are using your mobile phone, probably you'll be saying that, hey, I can't really, you know, scan the QR code, you know, with my handphone now. Rest assured, after the whole event, we will also be sending you guys an email on how to retrieve the presentation deck. And, you know, if you have any other enquiries, you can also feel free to fill up the same QR code by scanning the same QR code to fill up the forms. So now we'll have back all 4 speakers back with us, and, you know, let us have a look at what are some of the questions you guys have posted. You know, I'll probably give you guys some time to start posting some of the questions, and maybe for the to kickstart the whole Q&A questions, you know, I do really have participants really been asking, I think, more of the economic view in general, which I think this question will be directing to Ablash. So Ablash, you know, you're seeing that, you know, you're quite optimistic about the prospect of the global growth recovery, okay? So what about, you know, the risk of a second wave of impact, or, you know, like trade tensions, you know, moving forward? What do you see? What are some of the impacts, you know, that will be impacting the market in the next, you know, couple of 1 year to maybe the next 1.5 year moving forward? Especially, I do also have a participant is asking, like, you know, will vaccines, you know, be one of the key events that be affecting the economic recovery in general? So maybe you can, you know, talk more about your views on it.
So let me talk about the trade tensions first, and then we'll talk about economic recovery and second wave. So see, we have seen the trade tensions between US and China really rise in the last couple of weeks. But for us, this does not come as a surprise. And this is something our investment committee has been highlighting for some time, that geopolitical risks are still there despite the COVID-19. Now, what's the incentive for Trump and, you know, China to have this tension there? I think it's very, very simple if you think about it. So if you talk about US, you have the presidential elections coming up in November 2020. One thing that comes out clearly from a lot of surveys in terms of US population is that a lot of population in US, I think the figure is 60 to 65%, wants US politicians to be more, you know, strict or tough on China. So being tough on China or trying to flare up tensions with China is something which at least some surveys in US indicate could be a good strategy to gain vote share, right? However, Trump has an incentive, in our opinion, to not, you know, increase tensions too much, because if that happens, we could have a repeat of what happened last year, that people get so concerned about trade tensions that stock markets and economies start tanking, and that's the last thing we need right now, right? So we think, yes, trade tensions will be in the headlines, but there is incentive from both China and US to not let them get so out of hand that it starts hurting the growth. Now, if we talk about you know, a possibility of second wave and, you know, what could be the vaccinations available, when they could be available, I think, yes, second wave is a risk, and that's something we did talk about, you know, in the presentation. However, I mean, one thing that we are seeing as more economies open up is you know, people have got used to social distancing, working from home. So yes, unless a vaccine is developed, it's unlikely we will go back to how things were in January. But that doesn't mean that, you know, the economies will remain in a lockdown. Countries will try to open up economies slowly and steadily in a more calibrated fashion, because the cost of keeping the economy shut down is far, far too high. So even if there's a second wave, you could have a period of rolling lockdowns where measures are temporarily increased. and then relaxed as number of cases come down. But all through all, we've seen a big progress being made in terms of people being allowed to work from home in industries where they can. Obviously, if you're talking about manufacturing industry, it's a challenge there. But for instance, in the banking industry, most of our team is working from home with limited interruptions. So there will be industries which are impacted differently, but by and large, you should see better preparedness for that. As far as vaccines are concerned, I was looking at a research from OECD, and what they highlighted, and this is dated 26th May, is that there are 10 vaccines which are currently in trial, and there are 2 vaccines which are where the trials are supposed to end, later in 2020. But for most of the vaccines, the trials usually are expected to end in middle to late 2021. So that is one date that we can think about in terms of when potentially could we have a vaccine. Obviously, there's a big uncertainty. It could take longer or shorter, but that's the best data that we have right now. However, I think as business owners or as investors, we should also remember that approval of a vaccine in clinical trial is not the end of story. Then you have to think about getting the vaccine manufactured and available to population around the world. And that could take a few months at the minimum for it to happen.
Okay, thanks, Abdish. Sorry, DJ, do you have anything to add on, especially on the currency of it, from my understanding?
No, I think it is related to the dollar question that was asked in the Q&A. So I can address the question now if you would like on dollar weakness.
Oh, definitely, because I do have one participant asking, why is USD less preferred? What are your views on it? Yep.
So maybe I'll start on splitting our views down into 2 time horizons. So over the next 1 to 3 months, we expect a sideways trading dollar, and over the 6 to 12 months, a weaker dollar. So I think it's important to understand that the dollar index that we use, 60% is made up of the euro. So as to the bullish arguments for the euro, I think I've covered that in the presentation. But what I'll do is explain a little bit more on the dollar feedback loop we've been seeing over the recent months and how the dollar plays out through the real economy and financial markets is via 3 channels. Number 1, it is the invoicing channel. Number 2, the financing channel. And number 3, capital flows. Now, as business owners, I'm sure you're very familiar with the first 2 channels I mentioned, which is invoicing and financing. As you know, a lot of invoices are priced in dollars. Dollars make up around, I think, 60 to 70% of global trade invoices. So that being said, the dollar is sticky from a global economy perspective. In terms of the financing channel, be it what we saw over the past few months, was that as the global economy went into lockdown, COVID-19 pandemic accelerated, what you see is that supply chains, which have been extended in recent years, they were impacted. And what this means is that companies tend to hoard US dollars in anticipation of liquidity drawdowns or liquidity needs. If you take the counterparties to that trade, it is the banks who also need dollars because they have their funding from dollars as well. At the same time, they also need to ensure they have sufficient liquidity to tide them through the same crisis as business owners do. So if you take both sides of the argument, both banks and both business owners need dollars, and that has impacted the dollar safe haven demand, which I highlighted earlier. And if you think about what the Fed, the US Central Bank, has done here is try to increase dollar liquidity, making sure it flows throughout parts of the world that need the most. For example, in emerging market economies, there are direct swap lines to the central banks now. What is needed is for these emerging market central banks to pass these dollars to the corporates that need it the most. So given that the Fed has already recognized these needs, and if we expect, like what Abhilash highlighted earlier, global growth to gradually recover over the next few months, dollar safe haven demand should gradually come down, which should point towards narrowing growth differentials in favor of other economies like the Euro area, Australia, China, which has seen growing credit impulse. We believe these factors should gradually lead to a weaker dollar over the medium term. That said, Abhilash highlighted earlier, rising geopolitical tensions, i.e. US-China, this could, you could see the dollar trade in a relatively volatile fashion over the coming few weeks. So that is a risk to our near-term view. But if you take all the considerations into account, a bearish dollar looks like the most likely scenario over the coming months.
Okay, can sure. Thanks, DJ. Thanks for the answer. Okay, moving forward, right? I do have someone. Since we are on, forex currencies, I do have someone on the chat area. He states that, Mr. KP Cole, he states that he disagrees with your statement that gold is a safe haven for hedging. To him, gold is no longer used as reserve for central bank. That's one of his questions. So probably, either DJ or Ablash, I would probably need you to answer your reasonings to it on the gold area. And okay, for CNY, he felt that you guys didn't factor in the manipulation to depress the currency when there's a trade war accelerating. So maybe DJ, can you also help to address on the CNY currency moving forward? Yep.
Sure. So maybe I'll touch on gold first. So the question I'm getting is whether gold is still considered a safe haven and whether central banks are still buying. So I'll address the first bit on safe haven properties. I think gold is still a safe haven over the next few months or so. What you saw in the gold drawdown over the past 2 or 3 months or so was the fact that it was impacted by liquidity-driven needs. So when everything, say for example, in the February drawdown or March sell-off, what you saw is that everything sold off, even gold, which should have been fairly resilient. But the reason or the explanation for this drawdown in gold prices as well is the fact that the people who bought gold going into the COVID-19 pandemic, positioning-wise was really long, which means that a lot of investors already held golds in their portfolio. And when you see everything in your portfolio sell down, you need to raise some cash to make sure, to make margin calls, to make sure your margin calls are met, or to ensure that you have sufficient cash on hand. So with that being said, you did see gold draw down slightly to around 1450, where a lot of the people who were long initially took profits or raised cash to fund the other assets that weren't doing so well. So that's on a safe haven bit. We still think gold is a safe haven. If you look at what is done over the past few weeks, you did see US-China trade tensions. Gold has still been fairly resilient. It's still above 1700. In terms of central bank buying, yes, I agree that central bank buying has slowed. But if you take the point and you look at what the US has been doing to the US dollar, now the US dollar is slowly being weaponized. You see that through US President Trump's threats or news that they will impose tariffs or they will try to cut certain countries out of the dollar capital markets. I think that is still something to be mindful of. In terms of central bank buying, if you look at the key actors behind the scene, China, Russia, they're still buying gold, while gold is still a small portion of global reserves. I think it's gradually increasing in importance. So to that bit, if you take the key drivers for gold prices, which is real use, and if you expect it to continue to function as safe haven, we think gold prices can still be supported over the coming few months. Bear in mind that we do not see a liquidity-driven crisis like what we saw earlier this year. So that's on gold. I'll touch on CNH now. So you look at CNH, dollar CNH, I think there is a political aspect and economic perspective to take, at least with regard to recent moves. I'll address the economic bit first. If you look at what China has been doing in terms of its economic policies, they've emphasized a lot of fiscal policy and also making sure that monetary policy is fairly stable. What they're trying to do is make sure growth is propped up without depreciating the currency. And this goes back to the political bit. When you talk about US-China tensions, any attempt or any big move in dollar CNH or say CNH weakening could be perceived as an attempt to undermine the current trade agreement that US and China have at the moment. Yes, the bias is for a weaker CNH, but we believe that the authorities will manage the volatility around that depreciation. So all in all, a range-bound dollar CNH, but we think that the incentive for policymakers remains that of propping up growth. And to that manner, it is important to make sure your capital flows do not floor the economy. So making sure everything remains stable. That said, dollar CNH likely trade sideways, but I think the bias for it should remain at around 710 over the next few months or so. Okay, so that's my answer for Go and CNH questions.
Okay, thank you, DJ. I hope that's answer KP Poe on his inquiries down there. Yep. We don't really have much time, so I'll quickly move forward to a question. We'll jump off to Zach. Zach, I do have a participant that's also asking like, what is a comfortable ARAP ratio and working capital cycle for SMEs? Moving forward to you.
Yeah, thank you. That is a very important question. What is the ARAP ratio? Of course, if you have more collection than you have payment, that's the most ideal situation, but that may not always be the case. On working capital cycle, we have to be cognizant that working capital cycle is very different from industry to industry. I'll be very happy to address this on one-on-one level if we can get more details from the participant.
Okay, can sure. Or maybe for those participants, if you have answered your question anonymously, maybe you can just drop us a private message to leave your contact details so that Standard Chartered Bank can, contact you directly. Because if you you post your question as anonymous on the Q&A, we won't be able to track who are you to reply to send an email to you directly. Okay, maybe I'll back to, a question on economy again to Ablash. Someone's asking on, what's the impact of Hong Kong losing their special status on Singapore and SMEs? As you know, Hong Kong, currently there's a, situation going on with China down there. And then how does it impact, Singapore and in general itself?
Thank you, Tiffany. I think it's an interesting question, but unfortunately, it's a question where we'll have to see how things proceed. And the reason I say this is there are two opposing forces out there. So on one hand, the instinctive reaction could be that, Hong Kong losing the special status is not a good news for Hong Kong economy as a whole, Hong Kong SMEs as a whole, and, other countries, be it Singapore or other countries in the region, could benefit from increased business prospects or increased operations given what's happened. However, there's another side to it which seems counterintuitive at first, but actually makes a bit more sense, and that is with Hong Kong losing special status and China pushing forward for implementation of the national security law. There could be a situation where Chinese companies and Chinese investors gain more confidence in investing in Hong Kong or in doing business with Hong Kong SMEs, because then if that were to happen, Hong Kong would come under the same legal framework as the rest of China, and the mainland Chinese businesses are more familiar, obviously, with that. And we saw this partly play out in the last couple of days if you look at equity markets. So initially, when this news was announced, Hong Kong equities did fall quite sharply. But what we saw was that, within a couple of days, we started seeing a lot of money flowing from mainland China into Hong Kong stocks. And the thinking in the market is that Chinese investors and companies are now more confident investing in Hong Kong or doing business with Hong Kong companies. So again, which of the two forces proves to be more powerful? That remains to be seen, but it's not a one-sided argument. That's what I would probably be able to say right now.
Okay, thank you, Ablash. Thanks for the answer. I think without much timing, I will move on to the last question, which is from Jimmy. Jimmy, I do have a participant who's asking on, you have been talking about the insurance coverage from companies, So, for a company to be interested, hey, in knowing the importance of the insurance coverage, how do they know how much insurance coverage should they have for their company? How would you advise them? Sometimes when we buy insurance, maybe you overbuy or maybe you're underbuying. So what is maybe the correct figure or benchmark that companies should know whether how much insurance is enough for them in general?
I see. Hi. Okay. So for in general wise, if it's for corporate, for business, I think it's the one school of thought be, the valuation of the company. Example, if you're shareholders, like I mentioned just now, shareholders as in partnership, right? They want to do, okay, so let's say they want to look at doing their shareholders agreement. So having the valuation of the business at current or up to a certain amount so that, facilitate that shareholder agreement so that one family or one partner gets the business, the other partner gets the insurance proceed. That's in the areas of partnership. in terms of the norm, key man, I think would be most of the customers we engaged, their motivation was to, in terms of remove these liabilities. So they will measure up to, let's say you have certain liabilities that you want to remove, or ongoing from now to as long as the business exists, probably you know that your liabilities is of a certain amount. It's all about the motivation of removing them if the next successor wants to, you see, to help and ensure that there's liquidity in the business. Things can still move on business as usual as possible should the unfortunate demise of the key person. For personal wise, because we do advise customers on a personal basis, I think it'll be depending on your dependents, how many dependents you have, that you want to support, how old or how young are them, right? And a number of years that you want that money, once in the case I'm gone. So if it's for children, how long would they be of a certain age whereby they'll be going to have their upon graduation and going out to work? So how many years I need to support them, and also ensure that probably another motivation like corporate, ensure that my home loan is fully redeemed, so that having a roof over my family, no worries on that. That was one of the few key motivation for individual and businesses.
Okay, Ken, sure. Thanks, Jimmy. Since we are on the insurance line, I'll just take one last question, which I think Alan is quite needs some advice on it. So we are talking previously. You're talking about legacy planning. So he's wondering, does legacy planning includes tax and estate planning using SPVS? Yep.
Using what? Sorry.
SPVS.
SPVS.
Yeah.
SPVs, special
purpose vehicles.
Oh, okay. So I think in terms of like I think at the start of this webinar, I'm not able to talk about tax, but when we do planning like this, we often have there's a high net worth team of our insurance company partners. They will have the special or necessary experts that we can come together. But I do hear that they will, in terms of having certain coverage involved, they want to ensure that not just loan. Example in this that you mentioned, tax to be in terms of fully redeemed and paid. And in terms of how they want to do it, I think that really is something that I can't advise for now. But if you need to, we can arrange, and together we can help you address this with our partners and their resources.
Okay, Ken, sure. Thanks, Jimmy. I think at the end of the day, for different businesses or company, if you're interested more about how, your company, how much insurance you're required, all this, maybe you can approach Stanchart Bank directly so that, they're able to give you one-to-one advices. And for those of the participants who we are unable to answer your inquiries, if you have if you have posed your question as a non-anonymous, we'll be able to reply your questions by emailing you. But if you have posed your question as an anonymous, I'm afraid probably you have to contact either Stanchart Bank directly or Singapore Chinese Chamber directly, and we'll forward your email to them. So I hope all the participants have gained a valuable insights of what have the team from Stanchart Bank has given to you guys. And without further ado, I would of course like to thank Jimmy, Zach, Ablash, and DJ for the wonderful presentation that they have given to our participants today. So we have come to the end of our presentations, and hope you guys stay safe and stay healthy as we see you in future SCCCI events. Thank you very much, everyone. Thank you.